Hello and welcome to Ask the Trader, a series where we take your most burning questions and give you the answers you need. I'm Dale Gillham, the Chief Analyst here at Wealth Within.
And I'm Janine Cox, Senior Analyst at Wealth Within.
Now, before we get stuck into your questions, I'd just like to mention that if you do have a question that you would like answered, please comment below and we'll respond to your questions in the next video.
If you're interested in some of our other content, you can watch other videos on our channel or listen to our Talking Wealth podcasts on Soundcloud. They're jam-packed with valuable information that will help you elevate your trading.
Time to get into those questions now. Now, the first question that we've got is from Catherine, and she's asking the best way to start teaching your kids about the share market. Now, I know you're really passionate about teaching kids in the share market.
Yeah, my suggestion is to actually put them in the car, go for a drive so they can't escape or go anywhere or start playing any games.
Not driving them off a cliff.
No. And then start discussing things around investing but it's always got to be with the kids about what's in it for them. So what's the end game? What will they get out of being involved in all of this? So you could start by asking them, what is it that they'd really like? So it may be that there's something that they've been hoping for, that maybe they didn't get it for Christmas and they want it. So it's about getting them to do some of the research and start looking into the share market. And you might point them towards a company, for instance, that they are interested in. It could even be something on the American Stock Exchange, the Australian Stock
Apple
Exchange.
or
Nike.
Coca-Cola.
Coca-Cola is on the Australian
McDonald's.
market. It could be something like Woolworths, which they may go to Safeway with you shopping. So that's always something interesting for kids. So you've really got to get their attention and focus and have them involved in the discussions around the dinner table. I think is important.
They're making it fun. It's probably the thing, and giving them, I won't say fake money, but giving them on paper money and actually say, okay, we've got $100,000, let's invest it in different stocks and see what happens over the next year. And
that's
then
a really good
bringing
idea.
it up all the time with them every week or every month, just talking to them a little bit about it and saying, oh, how are your shares doing and what's happening. And then when you go and visit Woolworths or you go and visit Coles or Target or those stores, saying, well, we've got some shares in that. So,
well, depending on how generous you feel, you might decide to start off with $10 and then let them choose a stock that they'd want to invest in. Like Dale's saying, it's a paper trading thing, not an actual real trade. And then see if they, can increase the value of that $10 over the year. Yeah,
and also some parents who just invest $1,000 for a child once a year. That's all they do. So from the year they're born, so they put $1,000 into a good blue chip stock, and as the child gets a little bit older, they start to realise what's going on because they're seeing the growth, and then you get the child involved in picking the next stock.
Yeah.
And so then obviously you'd hand that portfolio over to them at some stage when they're old enough to manage it, but you'd be teaching them to manage it.
What a fantastic 21st birthday present.
Oh, it is, here's your portfolio. It's going to have at least $21,000 into it in just raw capital plus all the growth, and that will help them for their first deposit on a house. Now, we can all, afford $1,000 a year, can't we, for our kids? Unless you've got 27 kids.
Well, yeah, that's it. And it may be that you have to have one fund or one little account that you're investing in for all of the family and run it that way.
Okay, so the next question we've got is from Jack. And Jack's asking if it's possible for a young person to be successful in trading the market. Now, my short answer is yeah. You just need to know how. How
fantastic for a young person to start this. The interesting thing is that most of us leave investing until 40s, 50s, and some even into their 60s when time's sort of running out and the urgency is greatest. But it's fantastic really to see a few more young people coming through and starting to inquire about doing our courses and wanting to really understand how to maximise their returns from the market. Recognising that the cost to actually buy an investment property these days is really prohibitive for a lot of young people. And this can be a great way to start. And I'll always remember your comment years ago about a friend of yours who started out with a portfolio of shares and that helped him with a deposit for a house.
Oh, absolutely. And to me, it's the times have changed from when I was a young person. Then it was more, housing was cheaper, they had less pressures on you. You also knew you're probably going to be in the same job for a long time. Now it's a lot more transient in your workforce. So you might only have a job for 2 years or 3 years or not even that, moving. So superannuation, we know, is not really cutting it for anybody because we're still retiring on pensions. So the earlier somebody starts, the better. And moving on from the earlier question is if that young person kept putting $1,000 a year into their portfolio from 18, for 10 years and they just left it and just kept compounding that return that they're getting, by the time they're 65, they'd have probably more than $1 million in today's value when they turn 65. So if they do it early, that compounding effect will take hold, and if they leave it alone so it can grow, they'll have a good retirement. So, but what happens is a lot of people won't leave it alone. Yep. And that's the thing. It's the discipline of understanding money. So to me, it's saying understand money, understand how to balance your budget, but also how to get into shares. And you'll find you'll get your properties earlier, so be able to buy your homes earlier and getting into investment property and build that share portfolio.
But
give you that.
At some point too, you've got to look at, well, do I become a bit more active in it? It's not just sort of like I put it under the bed and leave it there and hope that it's worth more when you come back to it, because a lot of people did that before the GFC. You know, they might have invested in the many years before, and then when the GFC hit, they came back to it, and of course their percentage was diminished. In some cases, people lost all of their money, 50% of their money, depending on what they'd invested in. So I would say that the tortoise and the hare is really relevant here. So it's about doing something with a sort of a systematic approach and recognising that what most people do is they tend to just put a few dollars in the share market. They don't invest in their own knowledge. And so when something goes wrong, they've got no idea what to do about it. So I'd say for a young person, learn to do it the right way first and get the knowledge.
Well, the best investment is in yourself first, isn't it? And that's really what we're talking about. So the next question we've got is Harry, and he's asking, is it worth trading cryptocurrencies? And it's one of those subjects.
Have you checked on what the Bitcoin's trading at lately?
No, I tend not to watch it because people tend to ring me up and tell me what it is, but I know it's not fantastic.
It's been pretty volatile, hasn't it? I know it fell to around, what was it, 50% of what its high was?
Nearly 60% of what it was.
60%, yeah.
Yeah, so it did have a very big fall. And to us, that was just a normal bubble type situation. And I know, we've seen it so many times with individual stocks. We've seen it with markets like the tech boom, the tech bust.
More the low liquidity type stocks where they're much higher risk, more speculative area of the market. But I mean, one thing that you've always instructed students is to never invest more than 10% of your money into something that's more higher risk, and always know how you're going to get out of it. And with cryptocurrencies, I think you've written many articles about this, warning people. I think there's some information on our website, isn't there, on that as well?
There's some articles on there. We've got some podcasts on Soundcloud and obviously in our Talking Wealth podcast in our website. So if you just Google Talking Wealth, you'll be able to listen to those podcasts.
Because this is really about chasing the next best thing, which is not really the way to invest properly for the long term if you want to make money. I mean, you'd just be like a lot of other people who, when the CFD craze came on, they leveraged themselves to the hilt before the GFC and lost money. And I mean, a lot of people have done some pretty crazy things we've been hearing with cryptocurrencies. So I would say it's not an area you want to focus on. You want to focus on actually doing the investing and making money the right way.
In the ebook we have on our website, we talk a little bit about risk and reward. The higher the reward, the higher the risk. The higher the level of knowledge needed to manage that risk. And cryptocurrencies are the highest risk thing that anybody can invest in today. Because they're unregulated, there's no system around that.
And yet we're seeing people with no knowledge at all going into that area.
And they generally tend to be the under 30s and the over 60s who are retiring, and they're the people that can't afford to lose it. And they really don't have the knowledge to understand it. So to me is if it's really, really high risk, as you said, put a smaller little bit of bet in it. And any money you put into cryptocurrency, you must be 100% happy that if it blows up and you lose every single cent of that, then you're not going to beat yourself up. If you can't do that, then stay right out of it. But again, everything old, or what is perceived to be old, is a far better way of creating wealth, not through cryptocurrencies. It is fairly high risk at the moment, so I'd stay right out of that.